For most people, the story of a national collapse follows a simple, tragic script. A currency evaporates, banks close, news broadcasts show pensioners weeping over worthless savings books. We are told it is a story of mismanagement, corruption, or global bad luck, a chaotic, painful failure where it seems everyone loses. But that script is a carefully maintained illusion, because while the cameras focus on the tears and the empty store shelves, a different scene is unfolding in a soundproofed office on the 42nd floor of a building with no name on the door. Here there are no tears, only a quiet, focused intensity. A financial model glows on a screen, its algorithms having circled this moment for months. The headline chaos isn't a tragedy here. It's a signal, a once-in-a-decade bell ringing the start of the most profitable trade in modern finance, the systematic harvesting of a failed state. This is not a story about bad luck. This is a story about a circuit, a pre-wired, legally fortified and brutally efficient circuit where national suffering is converted into concentrated, private wealth. Welcome to the untold truth of sovereign bankruptcy. This is how countries are taken apart, not with tanks, but with spreadsheets. And this is who profits when nations go broke. To understand this circuit, you must first forget everything you think you know about money and power. We imagine power as something visible, armies, political rallies, gold reserves in a vault. But the real architecture of modern power is legal and financial. It exists in the paragraphs of bond covenants written under English law. It lives in the clauses of an IMF bailout agreement. It operates in the absolute, unwavering priority given to one sacred principle above all others in global finance. The creditor must be paid. This principle is the foundation of the circuit. It turns a moral disaster into a mathematical certainty. The process begins not in the chaos of collapse, but in the quiet calm that precedes it. A country, let's call it a sovereign entity, in the cold language of finance, has borrowed for decades. Its bonds trade freely in London, New York, Frankfurt. For years, it's just another line on a pension fund's balance sheet. Then a trigger, a drop in the price of the one commodity it exports, a political scandal, or simply the global tide of cheap money turning back out to sea. The entity's borrowing costs begin to spike. It is now labeled distressed. This is the first signal. The vultures don't circle. They calculate. In hedge funds specializing in distressed sovereign debt, teams of analysts, often former IMF officials themselves, begin a brutal audit. They are not looking at the people, the culture, or the history. They are performing an autopsy on a still-living body. They calculate the recovery value. How much are the state-owned utilities worth if sold? What is the future tax stream of the population? What are the geopolitical stakes? Would Europe or America pay to prevent this country from falling into China's orbit? They are pricing the corpse and the insurance policy on the coffin. As panic spreads, traditional investors, pension funds, regional banks, flee. They sell the country's bonds at catastrophic losses, 30, 20, sometimes 10 cents on the dollar. They need the problem off their books. This is the fire sale. This is where the circuit is activated. The specialized funds are waiting. With cool precision, they begin buying. Not with emotion, but with a target allocation. They amass billions of dollars of this worthless debt for pennies. They are not investing in the country's future. They are acquiring a legal claim. They are becoming the country's largest, most aggressive and most patient creditor. And then they wait. They can afford to. Their capital comes from billionaires and institutional investors who measure time in decades, not news cycles. But a modern nation is never allowed to fully fail in isolation. Its collapse threatens banks in Berlin, trade routes in the Panama Canal, political stability in a whole region. So the international community intervenes. The International Monetary Fund and a coalition of richer nations assemble a bailout, a multi-billion-dollar loan presented as a lifeline to a drowning people. And here we reach the sacred, non-negotiable rule of the circuit, the first commandment of the global financial priesthood. Before you receive help, you must honor your debts. Read that again. The bailout is not cash for hospitals, salaries, or food. A significant portion is explicitly earmarked for debt repayment. The IMF's primary mission in a crisis is not humanitarian. It is to restore creditworthiness, to make the country a viable borrower again for the next cycle of lending. To do that, it must prove to the market one thing above all. Lenders will get their money back. This is the moment the patient fund steps out of the shadows and into the negotiation room. Their team, often lawyers who helped draft the very international debt laws they are now invoking, presents their case. It is simple, brutal, and backed by the threat of legal annihilation in courts. from London to New York. Their argument contains no morality. No politics, only contract law. We hold your debt. You need this bailout to survive. The rules of the system you are begging to re-enter state, you must pay your debts to get it. So pay us. Not the 20 cents we paid on the open market. Pay us 100 cents on the dollar, plus decades of accrued interest. The country's representatives sit across the table, trapped. Their hospitals have no medicine. Their ATMs spit paper. Civil unrest simmers in the streets outside. They have a gun to their head, and the bailout is the only key to the trigger. To refuse the funds is to accept total, immediate collapse. So they sign. The pen moves. The bailout funds are released. And in a digital heartbeat, a large portion of that money, the money sold to the public as a rescue package for the economy, is electronically transferred to the fund's offshore accounts. The math is staggering. A fund that paid $20 million now receives $100 million, a 400% return. In legendary cases like Argentina's decades-long war with Elliott management, the returns have exceeded 500%. Or where does this profit come from? It comes from the bailout loan. And what is the bailout? A new, even larger mountain of debt the collapsed country and its citizens now owe to the IMF and other sovereign lenders. The private profit has been socialized. The fund's gain is literally transferred onto the national ledger of the suffering population. The citizens, through their future taxes, are forced to take on new debt to enrich the speculators who preyed on their old debt. The circuit is now complete. Crisis, fire, sale, accumulation, bailout, transfer. It is a perpetual motion machine of extraction. Let's make this concrete. Let's follow the money through a real, modern autopsy. Greece, 2015-2018. Greece's debt crisis is well known. Years of overspending led to an unsustainable hole. By 2015, it was bankrupt. It negotiated the largest sovereign debt restructuring in history with its main creditors, European banks and governments. These banks, under political pressure, accepted a haircut, losing about 53% of the face value of their bonds. It was painful, but framed as a shared sacrifice for European stability. But not all creditors were at that table. While the world watched the main drama, a different class of investor was working in the shadows. Funds like Bracebridge Capitals of Boston were not interested in the new, restructured Greek debt. They were archaeologists of financial law. Funds like Bracebridge Capitals of Boston were not interested in the new, restructured Greek debt. They were archaeologists of financial law, hunting for old, obscure Greek bonds. Some were decades old, issued under English law, which had far stronger, more absolute protections for creditors than EU law. While the world watched the main drama, a different class of investor was working in the shadows. Funds like Bracebridge Capitals of Boston were not interested in the new, restructured Greek debt. They were archaeologists of financial law, hunting for old, obscure Greek bonds. Some were decades old, issued under English law, which had far stronger, more absolute protections for creditors than EU law. They quietly amassed over 600 million marsh of these antique claims, paying between 30 and 40 cents for every euro of debt. They became the legal ghosts in the machine. When Greece desperately needed its final $86 billion bailout tranche in 2018 to avoid being ejected from the Eurozone, Bracebridge and other holdout funds pounced. They sued in European courts. Their argument was merciless in its clarity. You paid the banks. The law says you must treat all creditors equally. Therefore, you must pay us too, in full. Exhausted, hollowed out, and facing an abyss, the Greek government folded. It used the new bailout money, the EU, taxpayer-funded rescue package, to pay these holdouts an estimated $2 billion to settle. Bracebridge likely doubled or tripled its money. The circuit hummed. The Greek pensioner, who saw her benefits cut for the 7th time, and the Boston financier, who saw his annual bonus skyrocket, were now connected by an invisible, direct pipeline of fiscal transfer. The Vulture was not breaking the law. It was using the law's own logic with surgical precision. This is the system. And like any ecosystem, it has its predators, its prey, and its enablers. It is tempting to paint the funds as lone wolves, as predatory outliers. This is a comforting fiction. The truth is more disturbing. Their profitable trade is not a bug in the system. It is a feature. It is enabled by the very institutions meant to guard stability, the credit rating agencies. Their dramatic downgrades from investment grade to junk are the starting pistol. They trigger the panic sell-off, creating the fire sale prices. The legal systems. Courts in New York and London are famously creditor-friendly. Their judges have allowed funds to seize a country's central bank deposits, its presidential plane, and even a visiting naval training ship. This is the legal artillery backing the financial threat, and most critically, the IMF. Its bailout framework, with its debts-first conditionality, is the ultimate catalyst. It transforms the fund's speculative gamble into a taxpayer-guaranteed return. The IMF doesn't do this to help vulture funds. It does it to uphold the sanctity of the global credit system. But the unintended consequence is this ruthless wealth transfer. This isn't a conspiracy. It is an alignment of incentives. Every major player is following its own rational, legal, and profitable script. The tragic outcome for millions is merely a calculable externality. A column in a spreadsheet labeled social adjustment costs. We must return always to the human cost. The algorithms, the basis points, the legal rulings, they abstract a reality of pure suffering. Meet Elena, a retired teacher in Athens. Her pension, cut 3 times, no longer covers her arthritis medication. The bailout that secured the holdout payments demanded her sacrifice. Meet the Carlos, a factory worker in Buenos Aires. His life savings, held in pesos, turned to dust in 2001. He started over at 50. The vulture funds that got paid in full in 2016 were paid with the future tax revenues from his labor. For the fund manager, these are externalities. For the economist, necessary adjustments. For Elena and Carlos, it is simply their life, diminished, hardened, made precarious by forces they will never see. In courtrooms they will never enter. Through logic, they will never be taught. The genius of the system is its opacity. The Greek pensioner does not see the line from her cold apartment to the heated swimming pool in a Connecticut mansion. The disconnect is the source of its power. Anger is diffused, directed at lazy politicians or abstract austerity, never at the specific, engineered architecture of the harvest. So who profits when countries go broke? The obvious answer: the fund managers, the lawyers, the advisors. But the deeper, more uncomfortable truth is this: the logic of financialized capital itself profits. It profits from the cycle: distress, fire sale, bailout, harvest. This is not an accident. It is the pinnacle of a system that has learned to commoditize failure, to securitize sovereignty, to price despair. The bailout isn't a lifeline. It is a debt pump. It primes the country with new obligations, preparing it for the next cycle of lending, speculation, and potential future harvest. The country is not saved. It is placed back on the treadmill, a little weaker, a little more indebted, its valuable assets a little more clearly mapped in the fund's databases for next time. The untold truth is that national bankruptcy in the 21st century is not the end of a line. It is a calm transfer station. Wealth is transferred from public treasuries and private savings into private funds. Power is transferred from democratic institutions, however flawed, to unaccountable financial tribunals. Agency is transferred from citizens to creditors. And this will happen again. It is happening now, somewhere. The algorithms are scanning. The funds are raising their next distressed sovereign opportunity fund. The legal theories are being polished. They are waiting for the next signal, the next headline of chaos. They are waiting to turn that national tragedy into their ledger's most profitable line item. In a world built on debt, the ultimate power no longer lies with those who print the currency, but with those who own the obligation and control the legal system that enforces it. They don't need to conquer a country. They simply need to finance its politicians, wait for its miscalculation, and then enforce the terms of its surrender. History's greatest empires were built on land, gold, and ideology. Today's most silent empire is being built on bankruptcy codes, bailout clauses, and sovereign distress. It is an empire without a flag, without a capital, and without a face. And its subjects never know they're living in it until the harvest has already begun.